class, welcome to Accounting 230. This is financial accounting. We're going to be going over lots of interesting things this semester. Let me start off by saying the first chapter, I don't have a video for that first chapter because it's just a lot of terms, and you can easily read through that first chapter and get an idea of what accounting's about, the different types of professions that are out there, learn about bookkeeping versus a true accountant, information like that. Now this is the next chapter. The next chapter starts off by talking about the financial statements, okay? And before I get into the first financial statement that we want to talk about, the balance sheet, I just want to explain the accounting equation. The accounting equation, which is assets equal liabilities plus owner's equity, okay? This is what makes up our balance sheet. But let's look at this accounting equation first. It is a mathematical equation. So assets are things that we own. Right, so let me put that down here, what we own. Liabilities, the other side of the equation, is what we owe. And then owner's equity is the claim that the owners of the company have. So I'm just going to put down the owner's claim in the business. So owner's claim. All right, so let's just go over some examples of each category here. Assets are things that we own. Okay, now we're talking about corporations here, businesses. So things that the businesses own, the most common would be their cash. I'm going to abbreviate here, but accounts receivable. Accounts receivable. These are like IOUs, when people owe us money. If we sell something, and oftentimes our sales are on credit, then people owe us money. They haven't given us the cash yet, but they owe us money. So they have an account with us that we're going to receive later, okay? So accounts receivable is an account that we're going to receive the cash later. Hopefully we get that cash, all right? Another one is inventory. Inventory is definitely an asset. It's things that we own that we're trying to sell, okay? And buildings. Buildings are another common asset. There's all sorts of assets, hundreds and hundreds of assets, but these are some very common assets that we own, okay? So now let's move on to liabilities. Liabilities is what we owe to other people. So the most common would be if we buy something on credit, so it's kind of the opposite of an accounts receivable. If we buy something on credit, then we have an accounts payable, meaning we have an account with somebody and we have to pay them off later. Okay, so that's an accounts payable. So basically, if you have two businesses here that are doing business with each other, if one buys something on credit, they have an accounts payable, the other one has the accounts receivable. Okay, so if there's an accounts payable, someone else or some other business has an accounts receivable in that same dollar amount. Okay, other liabilities would be such things as taxes payable. If we have a loan, we might have a loan or note payable. Okay, so these are all items that we owe money on. Okay, now on to owner's equity, the owner's claim. Well, for a corporation, there are two main owner's equities. We've got our capital stock. Our capital stock and our retained earnings. Now, this is for a corporation, all right? If you're a sole proprietorship or a partnership, these terms would be different, okay? But for a corporation, you have capital stock. Corporations can sell stock to people, out to the public. And when they buy, if you buy stock of a corporation, then you actually have an ownership in that corporation. So you can buy capital stock of companies like Walmart, Target, Chevron, all these companies out there. You can buy stock and then you own part of that company. Okay, so that's the capital stock. Retained earnings are just the profits that keep coming back each year. Okay, our earnings retained in the business. All right, so and that belongs to our owners. Any profits belong to the owner, so that's why it's under owner's equity and part of owner's claim. All right, let's just look at a quick example before we move on to the balance sheet. how do we get our assets? They don't just appear, all right? So let's just take the first one, cash, right here. Let's say this business is just starting out. And if this business is just starting out, they need to have cash. So where do they get the cash from? Well, this is an equation. They would get it from something on the other side of the equation, right? So they may go to the bank and borrow $10,000, okay? So you'd see our accounting equation would be in balance. Cash is $10,000. How did we get it? From a note payable, $10,000, okay? Or let's say we didn't get it from a note payable. Let's say that this is our business, and let's say we bought stock. We put money into our corporation. Well, if that's the case, then cash would go up $10,000, and our ownership interest in the company would also go up $10,000. So we would have capital stock, all right? So now don't get this confused here. Every transaction has at least two things going on, all right? Every transaction has two things going on. So when you invest money in a corporation, then you're going to have cash as one thing, and then we're going to record the owner's claim on the other side. Accounting always balances out, okay? So this is the accounting equation. Assets equal liabilities plus owner's equity. Now let me erase this. And I'm just going to write quickly on the board the balance sheet. The balance sheet is a formal financial statement. The balance sheet is a formal financial statement that corporations file, okay? It keeps track of, typically, you'll see it in this format, it'll keep track of assets, and then it'll have your liabilities and your owner's equity. So I don't have time to write all these things out, but it would list out cash, accounts receivable, supplies, inventory, computers, buildings, fixed assets. It would list out your assets. And then it would also list out in detail your different types of liabilities, okay? Now some of them might be summed up together, but it's gonna list out in total all of your liabilities, and it would also show your owner's equity. So it's called the balance sheet. I'm sure you can see why, because it's gonna balance out. If you have $1 million in assets, then over on this side, you're gonna have $1 million of liabilities and owner's equity combined, okay? This side's gonna equal that side, okay? So that's the format of a balance sheet. Now, there's something called a classified balance sheet that the chapter goes over that I just want to point out right now. A classified balance sheet is going to take our assets and it's going to have them as current, and I'm going to abbreviate here, LT. LT stands for long term, okay? So it's going to categorize the current assets. Excuse me. Current assets are cash or items that will be converted or likely converted to cash within the next year, okay? So we're looking to see how much current cash and things that can be converted to cash within the year. Long term would be those things that aren't going to be converted to cash within the next year, okay? Or don't have that ability to be. Liabilities also will be divided up like that too. Liabilities, you'll have your current liabilities and you'll have your non-current or long-term, your non-current liabilities, okay? So the current liabilities, just like current assets, are those things that will be paid off within the next year, okay? If that item is due within the next year, that would be current, okay? So now you can see what we're doing here. Current assets, you're hoping you have enough current assets to pay off your current liabilities. We're looking at the liquidity of the business. How liquid is the business? Are they going to be able to pay off their current liabilities, okay? So once again, this is a classified balance sheet when you have your current and long-term assets separated, because it gives people who are looking at the financial statements a better view of the business. And then you would also have your liabilities, current and non-current, also separated, okay? Owner's equity, we don't do that. Owner's equity does not have a current and non-current component. All right, and lastly, comparative financial statements. The chapter goes over comparative balance sheets, and what that means is it's going to show at least 2 or more years of activities. So they may be showing the current assets and liabilities, they may be showing these assets for this year, but if they also show last year's, which is helpful information, you want to see how it's changed. If they show 2 years, then that's called comparative, because you can compare them between the years. It's a very simple concept, but that's the term comparative balance sheets, meaning there's at least 2 years, and some businesses even put in 3 or more years, Okay, that's not unusual. All right, so this is the balance sheet. Assets equal to liabilities plus owner's equity. This is the accounting equation that's within this balance sheet. Okay, the next video we're going to go over the income statement, which shows the profit of the company. All right, so good luck with this, and if you have questions, go ahead and email me. Good luck with Accounting 230. Thanks.